My name is Rupert Younger, and I'm Director of Oxford University's Centre for Corporate Reputation here at the Saïd Business School. I'm delighted to be moderating this evening's panel on the path to net zero, why and how for business and financial markets, a part of our Insight series, Business in the Next 25 Years. The 2018 IPCC Special Report on global warming advised that we need to keep global average temperature rise below 1.5 degrees to prevent catastrophic climate change. To deliver this, global net human-caused emission of carbon dioxide need to fall by about 45% from 2010 levels by 2030, reaching net zero at around 2050. Net zero in simple terms is achieved when emissions of greenhouse gases into the Earth's atmosphere are matched by the removal of the same amount from the atmosphere. Delivering this at scale requires concerted action and sustained commitment. Our guests this evening bring policy, business, and investor perspectives on this critical issue. It's therefore my great pleasure to introduce our distinguished panel here today. Professor Myles Allen, on my left, is Professor of Geosystems Science in the School of Geography and the Environment here at the University of Oxford. He's a global expert on decarbonisation strategies, having served on the UN's Intergovernmental Panel on Climate Change since 2001. And Simpson, on Myles's left, has recently taken up the role as Head of Sustainability at Franklin Templeton, one of the world's largest and most established investment managers. She's one of the foremost experts in sustainable finance, having led the board governance and sustainability at CalPERS, the world's largest asset owners, for many years. She has shaped corporate boardrooms, most recently supporting Engine No. 1's governance reforms at Exxon, and has written several books on the finance ecosystem. On her left, Alan Jope, who is Chief Executive of Unilever, joining Unilever in 1985 and becoming Chief Executive in 2019. He has pushed forward Unilever's vision of making sustainable living commonplace, building on Paul Polman's legacy. He has spoken passionately about business rationale for sustainability, pointing to compelling evidence of consumer preferences for sustainable and purpose-led brands as the core driver of the group's strategic choices. And on his left, Julia Hoggett joined the London Stock Exchange as its CEO in 2021, following a career in capital markets, initially as an investment banker and subsequently as Director of Market Oversight at the UK's Financial Conduct Authority. She has spoken extensively about the role of financial markets in the climate transition and is now in a role where she can shape how markets innovate to connect pools of capital with the opportunities of the green economy. So on behalf of all of us here at the Saïd Business School, let me start by thanking you all for taking the time to be with us here this evening. Thank you very much. So the structure of this evening's session will be as follows. I will ask each of our panelists to speak for no more than 7 minutes, and I will be watching, to each of you about the path to net zero. I will give each of you notification when you have 2 minutes left. We'll develop some of the themes and issues being put forward before then opening up to any of you for questions. If you would like to ask a question, please do so using the Mentimeter QR code that is on your screens if you're logged in. Otherwise, I believe that most of your smartphones will be able to scan it from this distance here. So please definitely put in your questions into Mentimeter. And if you wouldn't mind putting your name and affiliation as well, so that when you do ask a question, I can identify where it's come from. That would be super helpful. Thank you so much. So to our discussion, Professor Myles Allen, over to you, please.
Right. Well, good evening, everybody. Thank you very much for joining us, and thank you very much to those joining us online. The topic is the why and how of net zero. So I think since I'm talking first, I'm primarily to talk to the why. Why net zero? Just to remind you, in a nutshell, it's because it's what it'll take to stop global warming. You probably didn't need to come here to learn that, but just thinking about that helps us think a little bit more about the how and indeed what net zero actually means. Because net zero has started, it's become one of those phrases where everybody's agreed it's a good idea before quite agreeing what it means. A bit like Brexit, you might say. No. So we want to avoid ending up in a situation where we've all agreed something's a good idea with lots of different interpretations of what it means. So it does help to take a step back and remind ourselves where this concept came from, what it'll take to stop global warming, what this means for the urgency of reaching net zero, and what it also means for the strategies we need to get there. So only 15 years ago, we were in a very, very different place in climate policy. The idea of stopping global warming was to bring emissions into balance with natural sinks of carbon dioxide, Mother Nature's ability to take carbon dioxide back out of the atmosphere. And everybody at that time believed in the concept of what was called, well, in the climate policy community at least, the focus was entirely on this model of contraction and convergence of emissions, whereby per capita emissions in rich countries would come down to a level where per capita emissions from developing countries could come up and meet them. We'd all meet together in the middle at a sustainable rate of carbon dioxide emissions going forward, and we'd all live happily ever after. The only problem with this model was that, which was of course extremely convenient because it allowed the developing world to increase its emissions even as the developed world were reducing them. The only problem with this model was that it didn't square with the science. And thanks to a series of papers that came out, some of them from Oxford I should like to stress, in the late 2000s, we established that the long-term sustainable rate of net emissions of anthropogenic net human-induced emissions of carbon dioxide to the atmosphere was actually zero, meaning we couldn't count on Mother Nature mopping up any of our carbon dioxide emissions. If we wanted to stop the world from warming further, we would have to actively take carbon dioxide back out of the atmosphere and dispose of it ourselves. This was a huge shift in climate policy, and I think it's really important to recognize that that shift was made, because it's very easy to get rather downbeat about climate policy. Within 6 years of these papers being published in the literature, new science appearing, the world acknowledged it. 190 countries signed up in the Paris Agreement, Article 4, which committed to achieving net zero in the second half of this century. Now, that in itself, and indeed going further than that, in the Glasgow Climate Pact, if you add up the pledges to net zero in the Glasgow Climate Pact, they're not enough to limit warming to 1.5 degrees, but they are just about enough to give us a 50-50 odds or so of limiting warming to 2 degrees, which is a very different position to where we were only a few years ago. So I think we do need to acknowledge the successes in climate policy, while at the same time admitting there's an awful lot still to be done. And the crucial thing still to be done comes back down to what net zero means, and thinking about the origin of the concept as to what it has to mean if it's actually to deliver on the goal of stopping global warming. The crucial point is we can't rely on the biosphere to mop up fossil carbon emissions. And if you remember nothing else from my remarks this evening, turning rocks into trees is not a sustainable activity. And unfortunately, for a lot of the world, that's what net zero means right now. It means fly to whatever conference you want to fly to. I'm a climate scientist, I fly to lots of conferences, so I'm among them. And then tick the box to plant some trees somewhere, mop up the carbon, net in the atmosphere, job done. Now, you've only got to take a step back and realize that's not going to work forever. What we need is to achieve a durable net zero. And by the way, this is nicely, if you want to follow up, this is nicely outlined in a paper led by Sam Funkhauser from the Oxford Net Zero Initiative, which appeared in Nature Climate Change just a few weeks ago. If you want to achieve a durable net zero, we have to balance carbon fluxes between the geosphere, rocks and stuff underground, like hydrocarbons, the biosphere, trees, near coastal oceans, these are mangrove swamps and so on, and the atmosphere. We can't afford a net zero which involves a steady flux of carbon from the geosphere to the biosphere, even if the atmosphere is already stabilized, because that's not a stable situation. In the end, any remaining fossil carbon that we burn will have to be balanced by geological disposal of carbon dioxide. That's the long-term challenge we face. Any net zero strategy worth its salt has to acknowledge that by 2050, every ton of carbon dioxide that's generated by remaining use of fossil fuels will be compensated for by a ton of carbon dioxide permanently disposed of, either back underground or turned back into rock. Unfortunately, this is one of the things they didn't acknowledge at COP26. We tried pretty hard to persuade people to say that, and nobody in the climate establishment is prepared to come out and acknowledge this really simple and obvious fact. The problem is it has some uncomfortable implications for net zero strategies today, not all of which look like they're on track to this fully durable, balanced net zero that we need to be aiming for by 2050. And above all, we are not remotely close to investing in our ability to dispose of carbon dioxide permanently that we need to be if we're actually going to make that goal. So I hope we're going to talk about more of that this evening.
Remarkable.
Wow.
You did warn me.
And I would like to point out that was 7 minutes on the dot. So, Anne, an investor perspective.
Well, first of all, it's lovely to be here. This is also my first outing as a fellow of Oxford, which is a great joy and delight to be appointed as such. And this is my first effort at being a jolly good fellow, right? So anyway, it's wonderful to be here with all of you, and welcome to everyone who's joining us online, and maybe some of you are going to listen in a bit later. So when we were talking about this session and when we were talking about the path to net zero, I have to be honest, part of me was thinking we should call this the road to perdition, or the road to hell is paved with good intentions, or something which really captures this sense of how fraught and vital and complicated this is all going to be. And I think Myles has set out beautifully what some of the challenges are. But really what I'd like to focus on is the how. And I think we'll leave it for the why. I know we've got pictures of polar bears and elephants and all sorts, but really, what we have to accept is that in this planning for the transition to net zero, we've got to put people at the center. And that's something that I think the financial system is starting to wonder about how to do a better job of. Because the debate so far, and certainly this was true at COP26, Julia and I were both there in Glasgow together, and I was at the Paris meetings as well back in 2015. And I think the way that finance was being considered was, all we need is huge sums of money to be deployed, and we can solve this problem. And, you know, Julia and I have laughed about this, but this idea that physics and finance in combination can actually get us where we need to be. It's a powerful combination, but there's a lot more to tackle. May we say politics, society, taking care of people along the way. So I also want to say, in this transition to net zero, putting people at the center is essential, not just for our common humanity, but also because the people provide the money that's in the financial system. We're not really talking about people in top hats and, you know, monocles like on the Monopoly board. All the money in the world that really matters on these issues comes from the savings of ordinary working people around the world. It's the pension funds, the insurance companies, I was working for a very big pension fund. I'm now working for a very big fund manager, but we're still taking care of other people's money. So, and that is quite a recent phenomenon in the capital markets. Until about 1980, the biggest source of money in the capital markets, as measured by the US, which is the biggest pool of money in the world, belonged to rich individuals. Now, nothing wrong with that. We're very happy for you to have the money to spend and deploy. But the global economy is resting on the idea that the financial system is not only there to provide the capital to industry and business whilst paying attention to natural capital, it's also going to serve a social purpose because it's paying people's retirement. In some markets like the United States, it's going to pay for their healthcare or their education. And these are social goods. So understanding the purpose of finance and who are the people providing this money into the system is a very important framing for any discussion we're going to have about the transition. So I think that's my overall point. The other thing to take on board is that right now the world economy is about 80% dependent on fossil fuels for energy. We can all get very excited about oil companies, and I know students have been at the forefront of calling for divestment, but 80%, sorry, it's the same number again, but it's 80%, not a typo, of the emissions that come from our use of fossil fuels actually are generated when other companies are using that energy. So it's the utilities that provide the electricity. It's transportation, whether we're flying or using a car or a train. So everything that we do, how we get around, how we plug in electrical devices, how we provide food and essential goods is relying on a fossil fuel dependent system. Although I must say one of the things I saw and made me laugh the most at COP26, among the different exhibitions where everyone was there saying, here are all the marvelous things we're doing for sustainability. My favorite, I have to say, was the one that, it must have been in one of the oil sections in this little booth saying, formerly trees. Kind of true, but that's not really where we are now, is it? Formerly trees. Yeah, I put formerly trees into my car. Anyway, there's plastic, formerly trees. All sounds a lot better. So let me just finish off. How many minutes have I got, Rupert? Because I'm not...
1 minute and 48 seconds.
Okay, that's 10 seconds on each thing. So there's three things for the financial markets to do. One is to allocate capital into the innovation and the solutions. That's one thing. Number two, why isn't that happening? Well, one reason is because markets don't have the data, the information, the standards against which big deployment of capital can take place. So don't have the information, and also we don't have the alignment of interests. We don't have carbon pricing. We don't have incentives and rewards internally lined up towards net zero. So all of that needs to be sorted out. And if you want to read more about this as an inflection point in finance, read, I don't know if Ben is here, but Ben Meng's paper in the Journal of Investment Management is very good on this point. And then thirdly, all the money in the world, at the end of the day, owns or finances part of the problem. So the ownership agenda is extremely important. And the initiative some of you will know about, Climate Action 100+, which has a $65 trillion fan club supporting the work. Just to give you a sense of hope, Bloomberg New Energy Finance calculated that the net zero commitments we've got from the companies we're engaging so far adds up to about 25% of global emissions. So the force of ownership, the force of capital allocation, but also the role of policymakers and regulators will be essential. So, you know, we've got a lot to do, and everyone has got a role in getting us and making sure it's not the road to hell. It is a pathway to net zero. Thanks.
Again, spot on 7 minutes. Thank you very much. Alan, you've got to keep this very, very efficient trend going.
Don't worry,
Company
Rupert.
perspective?
Have confidence. Well, it's also nice to be here. Unilever's been in the news a lot this year, and so my objective for the next few months is to generate fewer column inches, not more column inches for our company. But nevertheless, let me not begin by assuming everyone knows who Unilever are, what we do. So we're a reasonably large consumer products company, 52 billion euros of revenues. We have operations in 190 countries around the world, which is basically every country. There's 3.4 billion people a day in the world use a Unilever brand. And we sell something like 150 billion units of product a year. So we're a big consumer company, but we're also a big polluter in that regard. So we have a long history of sustainable business. Our founder, this guy William Lever, back in the 1880s, defined the mission of Unilever as being to make sustainable living commonplace and to lessen the load on women. Now, back in the day, that was quite an ambitious goal that he laid out. And with suspending modesty, we do usually top most of the surveys of companies that are putting sustainability at the heart of their strategy. And I want to say a little bit tonight about why we do that and how we do that. So we are not an NGO. We are strongly driven by a profit motive. But we believe that it's wrong to have a business strategy and a sustainability strategy that are separate. We believe in a multi-stakeholder model where when we take care of our team members, they take better care of our consumers and customers by doing the right thing for our business partners, for society and the planet. Then our shareholders will be preferentially rewarded. There is no trade-off between sustainable business choices and better financial outcomes. And indeed, that is our vision. Our vision is to be the global leader in sustainable business, and in doing so, drive superior financial performance. Now, there are a number of strands to the business case. First of all, our brands that offer solutions to consumers that make a positive impact for society or the planet are growing 3 times faster than the rest of our portfolio. It's simply people voting for sustainable choices with their wallet and their brand choices. Secondly, the myth that sustainability costs more is nonsense. We believe we've saved about €1 billion over the last 8 years through sustainable sourcing. Thirdly, we know that it reduces risk. A planet that's underwater or on fire is not a great planet to be running a consumer goods business in. And last but not least, it's a magnet for talent. Not just entry-level talent, but senior talent as well. And I'll not run through the data that we have on why sustainable business makes you more attractive as an employer. Now, we've got all kinds of commitments out there. There's 3 in particular that keep me awake at night. We've got some hugely stretching plastic reduction goals, which are due for delivery by 2025. We've said that everyone in our value chain, not just our employees, but our suppliers' employees, will make at least a fair living wage by 2030. We've already sorted it in our own operation, but we've now got to work on our suppliers. And the third commitment is that we'll be a net zero company by 2039. I'll say a word or two a minute on this. What on earth does net zero mean? There's some easy wins. 100% of the electricity that we use in our operations, all our factories, all our data centers, all our warehouses, all our offices are powered by renewable electricity that comes from green sources. And that was really easy to achieve. But it's not going to be enough. We have to fundamentally change some of our business models. One of our divisions we call home care. It's the stuff you use to clean your homes, to clean your clothes, laundry detergent, and so on. And basically, it is bottles of petrochemical-based chemistry. And we call that, it's fossil fuel-derived chemicals, and that's one source of carbon. And we've made the commitment that by 2030, 100% of the chemistry in our home care business will not come from fossil fuels. It'll come from green sources of carbon, so nature, blue sources of carbon, the ocean, purple sources of carbon, direct air capture, or gray sources of carbon, recycling. You can imagine the commitment to convert 100% of your chemistry from fossil fuel-derived carbon to those other renewable sources of carbon is filling our R&D scientists with a blend of excitement and dread. But it's a very exciting adventure. There are some tailwinds. The consumer is in our favor. Investors are increasingly in our favor. I love what you did with Exxon. Congratulations. Regulation is in our favor. Regulation is coming in the direction of that we like. And there are some certain high certainty scenarios. So a carbon tax is coming. One way or another, there will be a price on carbon. And we want to reduce our carbon footprint because we'll be exposed to lower carbon taxes. Final point, in December of 2020, we raised in our board a discussion of should we put our carbon reduction plan up for shareholder vote. So we wrote out a carbon plan which had some very stretching short, medium, and long-term goals, said what we were going to do in our operations, what we're going to do with our brands, what we're going to do with our value chain. And we put it to, rather nervously actually, to our shareholder vote. And it went through in our AGM last year with 99.6% shareholder support for the Carbon Reduction Action Plan. And basically what that's done is it's given us a mandate to get busy. And it's crystal clear shareholders want us to take action on carbon. Final point. Actually, I've got lots of final points. But let me just wrap up by saying we think there are three huge challenges in the world right now. The degradation of nature, rampant inequality, and climate change. And it's going to require cooperation across academia, government, business, civil society to tackle these big problems across geographies and across time. Thank you.
Who the 1% was.
Alan, thank you. It's always fantastic hearing what this amazing company is doing to lead the way. It provides a sort of very, very strong beacon for what other organizations can do practically. And that's what I think is really impressive about the work that you do. So great. Thank you so much. Julia.
Yes. So good afternoon, good evening, everybody. It's a real pleasure to be here. It's entirely Anne's fault, but I'm very grateful to her for it. I think I'm here to talk about the way the system and regulation can help in service of actually what you will have observed is a pretty coherent and consistent narrative on arguably what I would describe as the buy side, the sell side, and the science. I have a very simple logic for what I think stock exchanges are for. They work on a very simple premise. They are to connect those who have capital with those who need capital in service of an objective. And there is no higher objective than actually getting to net zero. So to not think that stock exchanges have a critical role is to misthink our purpose. So that's my starting point in terms of how we think about it. The other way I think about it is if you think about classical capital markets, fundamentally the entire ecosystem exists to figure out, to disclose, and to account for, and then to calculate, and then for Anne to be able to put a number against, and possibly to argue about whether she's right or not, the net present value of future cash flows. That is how the system works. But arguably, we need a financial ecosystem that serves our natural ecosystem. And therefore, we need to evolve to part of that network being able to discount for the future value of those cash flows considered against the cost and the impact on the planet. Now, more of that has been done than people realize. And it's partly because it's acronym soup, and it is also intensely boring to a large number of people who want to think about climate change as polar bears rather than international accounting standards and taxonomies. But that is actually the pipes and plumbing that has already been created in large measure, not totally, and there's some other fights we still need to have, but to reorientate, to enable that net present value to be calculated in a wholly different way. And we feel that we're at the heart of making sure that that happens. And the main ways we think about driving it are driving financing into the green economy and into the transition. And I think everything that's been said today makes it very clear how much needs to go into the transition itself. I have stolen a comment from Gil Scott-Heron to say that I think that the transition must be televised. And I feel incredibly strongly that actually making sure that the transition is taking place out loud, in public, with exactly the kind of discipline that's happening from investors like Anne in terms of what's happened on boards and getting the focus, rather than being allowed to hide away in the shadows, where it will still find the financing, but won't have the disciplines attached to it, is not something that shouldn't happen. So in the London Stock Exchange, we have one of the oldest sustainable bond market. We have a green economy mark that we direct capital to activity for equity issuers. Our fund market provides more financing into new technologies in green than any other part of our market at the moment. And we are building a voluntary carbon market. But when I arrived at the stock exchange, I said to all the teams, including one of them who's in the room tonight, well done, you've done a superb job in building this. We now need to deconstruct it. Because if you look at how financing is currently directed into the green economy, it's in very bifurcated parts of the economy. So you have a green bond, which is a very small part of the overall bond markets. Or you have the green economy mark, which is capturing a subset of our total issuers on the market. My vision is that by 2025, and I'm putting a date on it now, we will actually be able to look at the entirety of everything that's traded on our market and understand its impact on the environment. That's how you get there, not by having bifurcated pools of capital. So I've essentially said to the team, what you have done and what you have built is brilliant. I now need to build a pathway for the next 4 years to deconstruct the very thing that you have built. I'm calling it ESG as BAU, another acronym soup, but hopefully it gets us there. The next thing that we have a powerful job to do is drive dialogue. Because actually we do have a right and a responsibility to talk about the shape of capital markets. And we do seek to do that. I sort of describe it as have a megaphone, we'll use it. So we're very actively involved in GFANs and all the work that's been done in bringing the financial services sector together to direct capital where we need to go. But we're also putting our money where our mouth is. So we've invested in the other LSE, I'm afraid, not Oxford, but in the Grantham Institute at the London School of Economics, with TPI and Transition Pathway Initiative that Anne is very familiar with. They currently cover 400 companies for free in assessing and using their methodology to assess the transition of those companies. Our donation is to enable them to change that to 10,000 companies. And the expectation that we have as part of that donation is they make that information public and available to everybody for free. Because, again, the transition must be televised. And so it really matters to us that we can facilitate that and drive those standards. We also have a massive role to play in driving standards of disclosure. Now, I used to be the Director of Market Oversight for the Financial Conduct Authority, so I was in charge of the securities market regulation in the UK. And I was one of the people in the room advocating for the UK to make TCFD, the Task Force on Climate-Related Financial Disclosures, mandatory in the UK. And the UK is the first country that has done that, which also means the London Stock Exchange has to be the first stock exchange in the world to make sure we've produced guidance to companies on how to actually apply it. And we already have done. And we've worked very closely with the UN Sustainable Stock Exchange Initiative because there should be nowhere that capital can hide. We need to make sure that as stock exchanges around the world, we're equally trying to apply the same standards on this. And we've worked very hard on that. We also, as LSEG, run FTSE Russell and are providing climate Paris-aligned tilts to our indices, to the major indices, to enable investors already who are passive investors and therefore don't have necessarily the same capacity to have the voice that Anne can have at the table, to enable them to put their money where their mouth is in that regard as well. But I'm going to make one final point, which is why I'm here and why I'm so passionate about the physics and finance agenda. I have had to learn a huge amount over the years about sustainability, and I will never know enough. And what we know today will evolve so much. And a lot of what we're doing now, we'll find out in 5 years' time, wasn't quite right, and we've needed to pivot. And it won't be reducible to a tweet in terms of a binary simplicity. We're going to have to live with complexity and change and evolution and embrace it. And that's going to be really important for all of us to say. But we're also going to need an entire generation of people who can talk physics and finance. And that's why we need to change and transform the way we think about academia and curricula in this country, but also all over the world. Thank you.
Thank you, everyone. Some fantastic insights and some big challenges, actually, around this. I'm going to kick it off just with some questions that I'll point to one of you, but please feel free to join in. And if I may just, Julia, to start with you, just to pick up on this question around, well, for a start, it was quite complex with the alphabet soup that you were putting forward with all these different things. But in a way, that's part of the question I've got, which is that are the systems of measurement, in particular around Scope 1, Scope 2, Scope 3 emissions, for example, just too complicated? And are there too many systems? Is the challenge not to sort of simplify and unite and have one one uniform agreed metric that everyone can get behind? Or is that just impossible to achieve?
It's a very good question, and is the ultimate challenge at the moment, I think. So COP has made progress in terms of getting to the ISSB, so we've got a common standards board. TCFD, on some levels, was designed to be relatively straightforward to apply, actually. It is not rocket science, it is doable. And those who say it's too hard, I think, have not read the framework properly. And so there are pieces of that already. I think where we struggle is partially on taxonomies. And I have long argued that the perfect shouldn't be the enemy of the good in this regard. We saw quite a lot of institutions and entities use the complexity of all the different taxonomies as an excuse for inertia.
Right.
And you also have to think about, and the reason TCFD was made mandatory for premium listed companies in the UK first was very deliberate, which was to focus on the cohort of companies that had the resources and the capability, get them to set the standard that was good quality standard for others then to follow, rather than to do it all at the same time. And we have to recognize that there are companies who are actually, through the transition plans that are going to be mandated next year in the UK, going to be asked questions that they have never been asked before and don't have necessarily the resources and capability to deal with properly. When you're in Alan's world, it's a very different case, but when you're a small business where your bank is now asking you, what is your transition plan? I can imagine some of the reactions that are going to come in when those first sets of questions start coming in, as they already are. Right. And therefore, we do need to think about the perfect, but the possible. And I think we need to start with the possible. And I think there is now a growing, I feel quite strongly that the UK could resolve some of this by doing two things. One is thinking about a baseline taxonomy that is accessible to everybody, and then as a starting point. But also actually recognizing other taxonomies where we feel that they're reasonable enough, so that you can create that aggregation of capital. Yeah. Capital just needs pipes and plumbing to run down. And if it doesn't know because there are cracks in the pipes, because there's too many different options and too many different pathways you could go down, it won't flow efficiently. Right. And that is the thing that we do need to address.
And doesn't have the impact which it's required.
Yes, and it's a tension with the perfection of getting to the absolute right definition. And I think we have to acknowledge that, but have a grown-up conversation about it.
And add a little point to that, because I think Julia is absolutely spot on with this. We would not accept this kind of dithering and, oh my, it's all too difficult, if we were talking about financial measures. And what I think is very encouraging is seeing, even in private markets, I mean, we're seeing some big private equity firms now saying, well, your access to capital and the price at which you get the access is actually going to improve. So the coupon you're paying on a loan is going to be lower. So virtue is not its own reward. You're actually going to put some money behind it as well. And we've seen these measures on issues like diversity, equity, and inclusion. And back to putting people at the center of all of this, that's very important. We've also seen measures on issues like health and safety as a performance item, and of course on this transition to net zero is likewise. So I just think Julia's absolutely right. We have to stay practical, so have ambition to get this done, but some humility that we'll work it out as we go along.
So perhaps I could just sort of follow up on that and maybe ask Anne you to answer, but others may have a view on this as well, which is, how do we guard against symbolism and non-material commitments? When you have this complexity regime, people can get away with checkboxing and filling in stuff and saying they've done stuff without it actually being in any way meaningful. I know investors are very concerned about this. What's your thought on that question? And maybe others will have a view on that as well.
Okay, well, this goes right back to the beginning of trading and financial markets, and it's one of the 7 deadly sins, surely. We all understand this in any walk of life. So if you go back to the Bubble Act of come on, students, 1722? The South Sea bubble was one big scam. I mean, it pales Madoff and Milken and other more recent examples into almost irrelevant compared to the systemic impact of this. And remember, this was a scam designed to raise money to finance the slave trade as a way of earning money for the British Crown at a time when it was desperate to compete during the Spanish... Anyway, lots of things to remember about the financial system. So the issue about can you believe what you're being told is as old as the hills. And really, come back, I think, is where history helps us. If you go back and look at some of the debates in Britain, when the joint stock company, particularly limited liability, were being considered, the idea that you would have to put your trust in others if you parted with your money it is right there, and it's embedded in the original thinking, the governance structure, such that shareholders should have the right to hire and fire the board. There should be the production of report and accounts. We now sum it up even in the United States. These need to be true and fair. Then onto the auditor, who's going to be there appointed, hired and fired, we hope, not just approved of by the share-owning body, so that you've got all these checks and balances in place. So we want nothing less or nothing more than what we expect when we're it was first in Victorian times a way to persuade the British public to part with their hard-earned savings. So, the issue of, I was thinking about this whole thing, when the SEC's issued a regulatory risk alert on this issue. There's obviously a lot of rumblings in the European Union. And of course, investors want to know, have I bought what it says on the tin? I mean, things that we insist upon in buying a tin of beans, we're just asking for the same sort of thing when we're buying corporate shares.
It's true, of course.
It's snake oil.
It's true, of course, but shareholders have their own version of snake oil on this too.
Well,
I mean, there were stories
different
out this week about funds that actually claimed they were ESG and actually are investing in really non-E or S or G stocks.
That's the definitional model.
Right. So this is where complexity is the problem.
Well, it's complexity, but it's the lack of standard. So, as in all things, sauce for the goose is sauce for the gander.
Yeah.
The issues of investor accountability and governance, managing other people's money, are just as important as anything that's going on in the corporate sector. And we should never shirk from that.
Yeah.
So I know it's painful when these things get, raised, but if investors themselves cannot be transparent and accountable, they can't be trusted to be the stewards of other people's money, which is then deployed into the company. So to me, we're on the brink of finding a virtuous circle between financial markets, civil society, business, and actually regulators and, market practitioners.
I could trot off a whole litany of cliches that are relevant here. One is, you measure what you treasure. If you can't measure it, you can't manage it. You don't get what you expect, you get what you inspect. And I think what we have, I could keep, you want some more? There's a whole book of it. Anyway, the point here is that it's all anecdotal until you can measure it. Yeah. And I want to put a plug in here for the International Sustainability Standards Board that Julia mentioned. This is a valiant effort to come up with a standardized way of measuring companies' environmental and social impacts with the same discipline as we measure the P&L, the balance sheet, and the cash flow statement. Yeah. It was about 160 great companies from all around the world got together, asked the 4 major auditing firms to simplify this as far as possible. They've boiled it down to 23 different metrics across your people impact, your social impact, your environmental impact. And it's a report or explain. So if a metric's not relevant in your industry, then don't report it, don't measure it. But if it is relevant, then you better start measuring it. I think it's highly robust. I think it's the most bought into standard. It's been taken forward by the ISSB. And I just want to end with underscoring the I of International Sustainability Standards Boards, because as a multinational corporation, if we have to do this 190 different ways in 190 different countries, it will not happen, and it won't be useful. It won't be useful to the capital markets.
Right.
Well, we've got the SEC to think about as well.
Yeah.
Because the international does not extend, the SEC sits on the monitoring board, but anyway, the world's biggest capital market is not part of that system. So we've
They're not part of the
actually...
IFRS, so I haven't given up getting them into the ISSB.
No, I think that's going to be a slightly different thing. But the SEC is about to issue standards on climate change, on human capital management, and there's a whole realm of work. So I think also there's a danger of expecting too much too soon.
But
because let me finish.
Sorry.
When they issue those standards, they're going to have to go through 144 different jurisdictions. China, Japan, India, Europe, Canada, Australia, obviously the UK. So we've got to wait to see. So what I guess I'm saying is investors, we're not off the hook. We're going to have to keep driving this, and consumers will have to keep creating the incentives that you were talking about so eloquently. And we need civil society all around pushing it as well. So.
Myles, you have...
Sorry, Myles. We were rattling away there.
No, and I was feeling very excluded by all the acronyms. Sorry, I've just been given a microphone, which means you probably didn't hear anything I said earlier on, but it was brilliant. So I am going to pick an argument now. There's been a lot of talk about the complexity of this issue, and there's a lot of complexity in the world, but actually, climate change is astonishingly simple. And I have a confession to make. I spent the first 15 years of my career, typical climate researcher, wringing my hands saying it was more complicated than we thought. And then I spent the second 15 years of my career trying to undo the damage. And I think we all need to look at what we're doing and ask us, does it really need to be that complicated? At the end of the day, to stop global warming, we need to decarbonize 4 products: coal, gas, oil, and cement. So if we could stop each of those products from causing global warming, we are largely done. Yes, there's a few sort of sustainable forest management things that I'd like you to take care of, but I'm sure you're more than capable of doing so. Those are the big ones. And we don't think about this issue at the very simple product level. You've got a can of petrol, for example, gasoline, for those listening online. How do I stop that product from causing global warming? There's only 2 ways of doing it. One, you leave it in the can, you lock the can, and you institute a global ban to ensure that nobody, anywhere, ever will be allowed to burn it. If you think that's feasible, think about it a little bit more carefully. How else could you stop that product from causing global warming? Well, you can capture the carbon dioxide it generates and dispose of it safely and permanently, which right now means re-injecting that carbon dioxide back underground. There's no third option. So, in the end, when you stop and think about this problem at a product level, it's astonishingly simple. And back in the 90s and 2000s, we modeled a lot of our thinking on climate change, and still do to some extent, on how we saved the ozone layer. This was the great success story of environmentalism. And we didn't save the ozone layer with system change or changing consumer attitudes to personal hygiene by rationing deodorant. No, we changed the ozone layer by fixing the product that was causing the problem. And I'd really like us all, particularly you, Alan, to think about this problem at a product level, because I think it makes the whole problem much, much simpler.
Well, I want to add something in, I'm okay. I want to add one more bit, and it's back to the people. And when you've got communities like several 100 million people in India who do not have access to affordable energy, and in other parts of the world where this matters, if we don't work out this, I know you think about it as product, but you've got to think about it as people. And I'll give you an American example. We don't have to go to India or emerging markets to see this. Joe Manchin, senator for West Virginia, is a coal-producing state, concerned with, and he's a Democrat. Joe Biden could not get his package, which included vital stuff on climate change, over the line. So he couldn't get Joe Manchin behind him. So the just transition, which looks like a throwaway paragraph in the preamble to the Paris Agreement, if we don't work out how to include taking care of people with jobs, with communities, with access to energy, this is starting to get a bit more complicated, is it not? Where the political process will not be able to deliver what's needed.
Nobody ever talked to Joe Manchin about stopping coal from causing global warming.
Well,
Why?
that's not true.
Because the Green New Deal advocates in the US didn't want to know how to stop coal causing global warming because they wanted to stop coal, full stop.
No, it's more complicated
if we
than
hadn't, it's actually not that much more complicated than that.
Look at the labour unions who supported Biden, who've got their own unionised workforce having to make the transition in West Virginia. I think it's not as simple as you're saying.
We can stop coal causing global warming. Whether we'll still want to use coal, having stopped it causing global warming, I very much doubt. If you add on the cost of disposing the carbon dioxide, coal doesn't look like such a great source of energy. Natural gas does. Let me just give you one number just on this. So the cost of stopping the natural gas that most of us, certainly me, still use to heat our homes is, so the cost of capturing the carbon dioxide that will be generated by your home boiler and sticking it back underground would be less than the amount by which natural gas prices to the consumer in the UK are going to go up between last November and next April. And we've got 30 years to do it. You frame it that way, how is it that we have a problem?
So this is a good subject to pick up on. I'm going to start bringing in some of the questions, which thank you to all of you who have put questions into Mentimeter. Keep them coming. We've probably got too many already, but I'm going to see what I can do to throw them into the panel discussion. The first is actually really on this question of who bears the costs, because we're already seeing these spikes. And the transition, so Alessandra Guasti, a research fellow here at the school, asked, negative emissions are extremely costly. Can business deliver the investment and innovation necessary without limited regulatory incentives, for example? And should customers bear the ultimate price? So I don't know who wants to pick up this thorny question, but one of you needs to.
Well, I'm happy because I've been banging on about people. Look at the Gilets jaunes, look at the Joe Manchin example, look at how India, China, and Saudi Arabia diluted the final language in the Glasgow Pact. And it is also hanging on unfulfilled financial commitments from developed nations into what was promised as a $100 billion kitty to help the poorest nations make the transition. So things like carbon pricing have to be very carefully designed so that you don't punish the people with the least ability to afford to pay for whatever the transition must be. So I think this issue of a framework for transition plans at company level, country level, regional level, and in the United States, this is now work that's going on in interesting places like Colorado, big coal-producing state. But I want to leave one other thing in, is about the timeline that these things happen. I remember big Texas utility, NRG, putting forward a 25-year transition plan quite a few years ago, and a hedge fund jumped in, put 2 climate deniers onto the board, and that all went to the winds. So the role of hedge funds and the short-term raiders and the traders has also got to be put into the mix with all of this, with the policymakers. So that is also, you can make money out of the transition in the short term in ways that can upend some of the long-term plans. So I think it's partly the question of who pays, and the protection for the most vulnerable needs to be in the mix, which is why it's a social issue, not just a science issue.
And what
but
about
we've
the
also got to
policy
look
side?
at the
What about
timeline.
the policy side? Because I mean, so I think that is right. But is there a role for regulatory iron fists around this type of thing?
Iron carrots.
Iron carrots.
Iron carrots.
Doesn't sound very appealing, but
delicious,
but
I'm
yes.
sure.
So
Do you want to start and I'll pick up?
yeah,
I mean, to directly answer the question, the consumer's going to pay. The consumer always pays. It's the only source of capital. You made the point very well, Anne, that all this money in the capital system is the savings of ordinary people. So the way market economies work, it's the consumer that will pay. As far as regulation's concerned, it's enormously complex, but two things that I think would be relatively straightforward is to get rid of the perverse incentives that are in place that are driving further expansion, subsidizing further expansion of fossil fuels. That is barking mad. And then the second concept which we'd love to see is eliminating first mover disadvantage. Oftentimes it's the person who takes the first move to try and change the system that bears the cost. A very simple example. Right now, recycled plastic, which we want to use more of, costs more than virgin plastic. It's nuts, but it does. And it would be relatively simple to introduce good extended producer responsibility schemes that generate taxes from plastic and are used not just going into Rishi's general coffers, but rather get redeployed into the collection and processing infrastructure. Right. And those companies that get off their butts and start to, sorry, I'm not allowed to say things like that. Those companies that get moving would benefit from first mover advantage, not first mover disadvantage. Those are two quite straightforward regulatory interventions.
Yeah.
Julia?
I'm going to kind of pick up on what Alan said. I see very few things in life as binary, including football matches. And what I get very frustrated by is the idea that we construct this argument as a binary choice.
Right.
Now, it's only binary if you're really, really short-termist in your thinking.
Right.
It's not otherwise, because we have no choice. And some of this is about the coalition of long-term incentives. And one of the things that's quite interesting about and this came up in the conversations at COP, was when you transform the system so that people like Alan have to make commitments out loud and in public, and people like Anne are going to be holding him to it, that's got a really long time frame.
Right.
Far more than any political cycle, actually. And therefore, the more you can have that coalition focused on not seeing it as binary and being where the capital is driven to, the better. And I think that's where regulation has the greatest value. Right. Actually, most of our capital markets are founded on transparency. Right. And the more and this is why I think the UK does have an opportunity to lead. So we have TCFD as mandatory already. We also will have mandatory transition plans from next year. Now, there isn't another country that's doing that, and that is both for listed issuers and for asset owners. And that starts stretching into the private companies, because a lot of those asset owners own private companies. Yeah. It starts stretching into the way banks think, the way they function, the way they understand their client base as well. But it also means you then have the disclosure and the accountability, so that the people who are sort of trying to disguise this and not do it properly will get found out. They may not get found out immediately, right, but they will get found out. That's what the system is designed to do. One of the concerns I have about the greenwashing commentary is not that I'm not concerned about greenwashing, I am. It's that if we start with that, rather than starting with constructing the ecosystem in order to give us the information to be able to assess it, which is what we're actually trying to do, the risk is we switch people off and give them a sort of negative sense of the possible from the start. And I think we have to be very careful about that, because actually the consumer does want to be able to buy the right kind of investments, and they need the right information. Yeah. And they need not to think that it's all corrupt and switch off from the get-go. Right. And that, I think, really does matter. So the balance in this and the nuance, the roadmap that we actually have to follow, I think is well-trodden and well-known. Right. You know, the system already exists to do it. It just needs to be re-architected.
Yeah, this is really important.
So, Aoife Brophy, who's a joint scholar here and at the Smith School, asks, what does it mean, or should it mean, for a company to be net zero? Love thoughts in particular from Alan and Myles, she says. What should it mean for a company? So what actually should it mean for a company to net zero? What does a company need to do in simple terms to be net zero?
Can I kick off?
Yeah, sure.
I'll tell you what it will mean in 2050. Okay, and then we kind of have to think back from that. But 2050 is not very far away. So certainly most of your careers, it's going to matter for you. And that is that every drop of fossil fuel that company still uses or is used by that company's suppliers has to be hard net zero, meaning all the carbon dioxide it generates got rid of back underground. So one day, that's what net zero will need to mean. Right now, companies tend to look at their whole activities and try and work out how they can make their activities net zero, rather than looking at the things they buy and asking how they can make them net zero. And I think we're missing a trick there. I listened to a very interesting, stimulating conversation led by the CEO of a major airline at COP26, and he was describing all the sort of senior management time that they were investing in that airline into pursuing net zero. He never mentioned his fossil fuel suppliers. And at a stroke, that airline, by simply saying, I want to buy net zero fossil fuels, would completely transform the market. Of course, their suppliers would say, well, we'll have to charge you more for that. Of course you will. And in the end, the consumer pays. Air tickets will get more expensive in a net zero world. That's just the way it is. But I would just push back a little bit, and I'd love to know some more views of people in this room about whether if the consumer pays in the end, but in the short term, it seems to me the person who benefits most from the use of most of our fossil fuels is whoever owns it as it comes out of the ground. And that's where I think, again, we're missing a trick. We're not applying that principle of extended producer responsibility that you so rightly say should be applied to things like plastic. Why can't we apply it to oil itself? Why shouldn't whoever owns the oil coming out of the ground should take responsibility for their Scope 3 emissions?
Right,
and it will, but it's not any of the regulations.
That's not correct.
I'm sorry.
And investors, like I just tell you on the investor front, I'm agreeing
there is
with
no
you.
requirement on any fossil fuel company in the world to dispose of the carbon dioxide generated by its products.
Well, maybe not in the system you're suggesting about turning it into rock, but I just want to say that
or turn it into anything.
the investors around, no, because we're talking about not producing it in the first place, which is a bit different. But let me finish. The $65 trillion lined up in Climate Action 100 plus, it's Scope 1, Scope 2, Scope 3, and it's net zero. And Exxon, although it wasn't noticed, obviously replacing board directors is the ultimate thing you have a responsibility to do, which in part, 3 out of 4 candidates were successful at Exxon, which was a big deal. But the other thing that happened is, and CalPERS filed this proposal as part of a parallel initiative to require, not just request, require Exxon to report on its Scope 3 emissions. And that, because the company agreed, realizing they would lose the vote, was withdrawn. So they've made now a net zero commitment on Scope 1 and 2. Scope 3 is going to be reported on, and then that gets wrapped into the next round of discussion. So on the investor front, we are very, very clear that Scope 3 has to be in the calculation.
But Myles' point, of course, it's not required by law. I think
but it's required by the owners of the company,
Right.
which is a sort of parallel.
But can I
You can have one right of reply, and then we're going to move on to another question.
In a classic Today programme line, Bernard Looney was invited to be present, and he's not here, so I'm going to say it anyway. So BP has made a commitment on Scope 3 emissions, which involves turning rocks into trees. It doesn't add up. Companies need to make a real commitment on Scope 3 emissions, which means by 2050, every tonne of carbon dioxide generated by continued use of fossil fuels has to be disposed of back underground, and have a credible path there. They should be disposing of at least 10% of the carbon dioxide generated by their products by 2030. Right now, that fraction is 0.1% worldwide. I think it's slightly better than that for Exxon, but it's not great. And they have no plan. No fossil fuel company has a plan to start disposing permanently of the carbon dioxide generated by the products it sells at the rate that's required to get us remotely close to 100% by 2050. That's what's got to change. And their customers and their investors can change it. Because in the end, it'll be better for the industry if they go down this path and get on with it. But they're all stuck in exactly what you were saying about the sort of first mover disadvantage situation. If a single company stood up and started to invest big time in geological carbon dioxide disposal, they'd just lose business to Gazprom.
Well, let me give you a happy example. So Occidental, another of those companies, led by the remarkable Vicky Hollop, is betting the shop on the market for carbon capture and sequestration, because saying we know how to dig things up out of big holes in the ground, so we're perfectly positioned to be the people who do the pushing it back in. There is
You're absolutely
room.
right. I'm really cross that I missed my final punchline, which was the only exception to this is the one fossil fuel company in the world that's led by a
Is
woman.
Occidental. Now, I'm going to move it on. Otherwise, we're going to get into a fist fight.
No.
I'm going to move it on. I'm going to move it on because we have a ton of other questions. From Charmin Love, how are you identifying, enabling, empowering the activists who you no doubt have within your organisations?
Well, the
Who'd like to pick that up?
activists come as the good, the bad, and the ugly. And I can expand on that, but I feel I've said rather too much in general.
No, but I think her point was how are you going to unlock this latent talent for getting this net zero target delivered from within your organisations? What are you doing to unlock the R&D, the ideas, the activism? Perhaps, Alan, why don't you pick up first?
On the company side.
Yeah.
I must admit, I was rather pleased that the last question, which was a tricky one, was directed directly at me. And I didn't have to answer it. And, and furthermore, my Apple Watch said time to stand up, just as we were let me have a crack at that.
Well, why are you still sitting down?
Yeah, I know.
You just said everyone has to get off their bum.
Too sedentary.
Oh, yeah.
The question, I think, is about harnessing the appetite of people in our organisation to be change makers.
Yep.
And I do think someone said when I was appointed into this role, are you going to stick with Unilever's long-standing commitment to trying to move to be a more responsible and sustainable company? And it's the easiest question to answer in the world because it's 100 years in our DNA, number one. Number two, it makes good economic sense. But number three, I'd have a revolution on my hand if we tried to back off from our commitments and our agenda. And so like most things in the company, when we create space and empower people to take action, they do the right thing. Yeah. And the example I gave around our R&D teams being energized and somewhat daunted by the challenge of moving all of our chemistry and the cleaning products away from carbon sources into other colors of the rainbow, is replicated. We've got the same thing in our foods business. We're trying to move the system to plant-based foods in our company. We're trying to move our personal care business to a different definition of beauty. It's not about carbon, it's about social impact. So we've got activists up and down the company, and those who are not with the program kind of get rumbled and leave. It's just the opposite, actually. It's an unstoppable force, right, is the people in the organization. Right.
Well, we have 5 minutes left, so I'm going to ask a general question which has been asked by a number of different people. So I'm going to start with, and it's one really, I think, for everyone to give a final view on, if I may. It was kicked off with Rui Yao Renksford, who's a MSc Financial Economics student here, who asks, and I think you're in the audience, thank you for the question, how to make the net zero transition more inclusive from developing regions. And I had exactly the same question, which was really around that the regions with lower GDP per capita and those with greater fossil fuel resources are likely to need to invest more relative to GDP to reduce their emissions and build a low emissions economy. These countries also have relatively greater shares of their jobs, GDP and capital stock in sectors that would be most exposed to the transition. And some of them will face a double burden, of course, because they're exposed to the financial transition adjustments and the physical risks, right? Yeah. So how do we create an equitable transition? Maybe if we could ask everyone just to give a final comment on that before we wrap up. Who wants to go first? Julia, you're looking like you're up.
It's the hardest question of all. I was doing a podcast with the IFC on climate change at the end of last year, and they said, if you had a magic wand or were a fairy godmother, what would you want? And I said I would want us to be over the hump of the transition such that the economic impact on those who are most likely to be impacted the worst and had the least had been passed at that point. And that illustrates the scale of the problem. I started my academic career in Malawi looking at wood fuel use. So I feel like I've come full circle. And you can't use econometric methods to change people's behavior because they don't use money to deploy, to use energy, to consume energy. They just go and gather it, or they used to. Now they can't reach it in time. And so the reality is that we need to be much more nuanced about the way we think about it. The global north has, and capital markets have been very, very good at financing the global north, rubbish at providing capital into the global south. And we need to think about the way we're thinking about value differently, I think, going forwards. And actually the value to the climate that gets priced in going forward has the potential to unlock value in the global south that has not been unlocked before. I think about that through the lens of the voluntary carbon markets as well, where the investment and the cost of the global north paying for the investment into the activity that would not otherwise happen, that will give rise to voluntary carbon credits, has the potential to direct a lot of capital into the global south if constructed properly. But what it requires is a global cost of carbon. Right. It requires us not to have a fight for the lowest cost to deliver in every possible jurisdiction, because it's cheaper to sequester in the global south than it is in the global north, right. And then have that reduced cost accrue to the global north, right. Not to the global south. Right. And that is a really tough conversation to have in sort of macroeconomic terms, because competition would argue that, well, markets can be formed, right. Where they can be formed. Right. And so there is the question about at what point does somebody need to step in and address that question in my head.
Alan?
Very quickly, mitigation is more important than adaptation, but adaptation is the forgotten child of climate change. And there's not enough focus right now on the people in the developing world who are going to be smashed by climate change in a way that those of us living in privileged lives in the north will not experience the same effect. So we need to simultaneously deal with adaptation. It's not as important as mitigation, but it is important. And the second is cell phones, where the developing world skipped a whole generation of technology, the kind of fixed line phones. And we need some rapid innovation and invention to help so that the developing world can skip the generation of polluting technologies that we have today. And that will include sequestration in the south.
Right, yeah, good points. Anne?
Yeah, well, I can only say yes and agree, and thank you to Julia and Alan. They're both very important points. To be practical, I would say every single transition plan that might be required by a regulator or requested and then required by an investor needs to include the just transition, which is lifted directly as a term out of the Paris Agreement. What we've done at Climate Action 100 Plus is build this into the benchmark by which we're assessing companies along with CapEx, accounting, audit, political lobbying, all that good stuff. And that means companies right through their supply chains, just as Alan was saying, need to acknowledge, they need to consult, and they need to respond. And we want to see, and this is very consistent with the ILO guidelines on the same topic. If we don't do that, we'll get upended in the way that Biden's been upended through West Virginia not being attended to, through not being able to keep the global south rightly on track. And the other thing we need to take on board, it's not just the historical burden of emissions that's come out of our own industrialization efforts in the global north, the rich world. We have offshored our emissions production through globalization. So when we're picking up bits of soot and plastic to hang on our Christmas trees and, oh my, feeling very, quivering jowls about climate change, we've got to actually understand that the global supply chains, the situation of cheap coal and all the points Myles has been making have been very important. So we need this holistic approach. a life cycle approach from cradle to grave for all these different products. The reporting is key, as Julie is saying, and investors need to be held accountable as well. But in the appraisal, I really look forward to seeing the transition plans and the just transition element being properly mapped out. Because without that, it's going to be more warm words and precious little action.
Myles, take us home.
Well, at the risk of sounding like a stuck record, we need to stop fossil fuels from causing global warming. The people best placed to stop fossil fuels from causing global warming are the ones who are benefiting most from our use of fossil fuels at the moment, the people who own them as they come out of the ground. If we stop fossil fuels from causing global warming, future consumers, the vast majority of whom will be in what we now call the global south, can make up their minds how much they still want to use them. They will almost certainly use far, far less than we use today, but it'll be up to them. We need to empower them to use the resources they have to pursue the goals they want without destroying the planet. That's essential. And simply telling them to leave it in the ground when we in the UK were taking it out of the ground for 100 years before anybody else was, is utterly unacceptable. We, those who benefit most and have benefited most from the use of fossil fuels in the past, have an absolute duty to stop fossil fuels from causing global warming and not just wag our fingers at people and tell them they're not allowed to use them.
Well, I'd just like to say, first of all, a huge thank you to all of you for your questions. I'm sorry I didn't get to all of them. There were a lot, but I will share the questions with the panel just so that you know what they are. A huge thank you to all of our panelists for being here and for everything that you've contributed. And now you're all warmly invited to come for drinks in the quad, in the marquee. It's heated, I gather, thank goodness. But there's a heated marquee with some drinks. Please join us where you get a chance to interact and chat with the speakers. Thank you very much.
Thank you.